The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined as always by the brain trust himself, Mr. Chase Taylor. Interesting day in the market. Plenty to talk about. I'm focused on Google though, and for so many different reasons. And I think the big message here for Google, I think there's a big lesson in this. For those of you who don't know, Google hit another all-time high today. And a lot of it's off the momentum of them talking about their chips. We've been talking about their chips for a year and a half now, something like that. And it's like everybody is starting to wake up to what we've been talking about. And this is one of the things I think that people need to realize about this market is that, you know, like most bull markets, but I mean, this one is more like that than any I've personally seen. But everybody's just looking at charts, and we do too. It's a hugely important part of the input, but you also need to understand the fundamentals. And we were just laughing about it probably 2 weeks ago, back when they did that interview on CNBC with Josh Brown and his buddy, and how they were just dogging on Google and talking about how it's a loser. And again, this is not a shot at those guys. It's not what I mean, right? But it was so clear that they were looking at a chart and then melding the fundamentals around that to explain the chart, right? Well, that's how you miss great value opportunities, okay? Google was just overlooked. And a perfect way to discuss that was today. Gene Munster, I think, I'm trying to remember how Gene made his chops, but I know he was big, made a name for himself in Tesla, longtime Tesla bull, and a pretty prominent tech analyst. And in May of this year, he was on there saying how Google is not done going down. It's the worst out of the Meg 7. And I remember hearing his analysis, and it was a head scratcher. I sat there and went, you know, it's one of those where you go, guy must have missed something. And you go back to the data and you look at it and go, this guy's just wrong. He's just not looking at the facts. Today, so what are we? So what, 6 months later?
Google, a lot.
Yeah, the stock is up, what, 80% since he said that? Something like that, right?
More than 50.
More than 50. It's his top pick today.
The one with the RSI in the mid 80s is now his top pick.
Yeah, what was that cartoon you saw today? Tell the folks about the cartoon.
My buddy Aaron Chopra, Fusion Point Capital, he tweeted out a meme of nobody, you know, at the door of Google at whatever, like, you know, 2 times sales or whatever, but then everyone beating down the door and trying to get into the Google at 10 times sales.
And I don't think you could, the reason I thought that was such a funny, I don't think you could describe that market any better than that. Like that is this market.
That's the funny thing about stocks. They're a giffen good. People want them more as the price goes up.
Yes.
The demand increases.
Yes. Which go figure, right?
Right.
And look, guys, I have learned the hard way to not ignore charts. Okay. It is an important part of the input. But one thing you learn about investing is being a contrarian. Not all the time, but when everybody is doing one thing, you have to at least go examine the opposite.
Right. And to steal from Stanley Druckenmiller, like something that he said that it's just the way I naturally operate, so it's easy for me to say, but like you have to do. He said, you know, you have to visualize the situation 18 months from now. Never invest in the present. Invest in like where things were, you think they're going to be in 18 months.
Yep.
So this is a perfect example. Like if you go back 18 months ago, like none of this stuff was a slam dunk. We didn't know the chips would be that good and it would work this great, yada, yada, yada. But you could have looked at the fact that they were developing the chips and thought about what that could mean. And that could have been important. Or the fact that, like we said yesterday, you know, it's not, they were considered like a big AI loser, a giant net loser. And now all of a sudden everyone knows that they're the big AI winner. And it's like, when the only thing that changed was they made a good model along the way, because their core AI researchers were like, they were known as like the best ones on exactly with this technology for years.
Mhm.
Like they were the ones doing the hard work on this stuff.
Yep.
So yeah, I can't like foot stomp enough for people. Like if you're looking at last quarter and you're betting on that and thinking about that, and like you said, just looking at the chart or looking at whatever's hot now and be like, I need that. Like, no, like the best thing to do is look at things that aren't hot and then think about how they might be hot in a year or two.
Well, also welcome to the reason. And if people don't know this about both of us now, then they haven't listened for long enough, but you're never going to hear us. I was reading a tweet today from a very prominent investor on Twitter. Both of you and I know him. Decent guy, good guy. But he put out one of those tweets. The only way you're going to make it through this is if you follow me. You know what I mean? It was one of those furu type tweets, like look, guys, there's a way out of this cave, but only I know the way, And I just started laughing because I'm like, anybody that says that, like, it's hard for me to take you serious because if you've done this job for any period of time.
It's not hard for me to take that person serious. Impossible.
Yeah. Yeah. If you've done this job for any period of time, that's the last thing you think, right? It's like you said, if you hear the greatest investors interviewed, it's always caveats. Don't do what I do. Don't do it right. Because I could change that fast. Reality might change. But here's the biggest lesson I think people need to know. For everybody out there telling you value investing is dead, they're an idiot. Okay. It is not dead. It'll never be dead because investing is about buying discounted cash flows, period. Okay. So charts can help you find that. So can fundamentals. And what do you rely on more? I'm more fundamentals. Chase is more technicals. That's why we're a good team. That is also why Bulwark has two main stock portfolios. One that is basically run our momentum portfolio strictly off technicals, and our value portfolio that is run off fundamentals. Furthermore, the reason we did that is because there has been a ton of research, mostly the biggest one being Cliff Asness and AQR putting out that 100-page research paper about what's better, momentum or value. And what they found is if you combine both styles, that's the best, right? And this is why. Because you go through momentum-driven markets where fundamentals really don't matter and you're kind of pulling your hair out. And then you go into value-driven markets like this year. If you don't think fundamentals matter in investing, we would not have our two biggest winners by far in the book this year that we had. Gold miners, nobody liked them. Google, nobody liked that. Those were purely fundamental plays.
Both had RSIs get to all-time highs this year. It's hilarious.
Right. And then everybody wants in, right? And that's when we were taking profits on all that stuff and lean out. But you have to look at the fundamentals. When people sit there and talk about it being dead, that is just the dumbest thing, right? To me, it's as dumb as if people said charts don't matter, right?
Yeah, both are wrong.
Yeah.
And I will say, well, one thing that I think the hardest thing in investing, you talked about like, hey, this is the cash flows, is thinking about where cash flows might be on something in 5 to 10 years, because that's where like you get these crazy runs on something that looks too expensive. And next thing you know, it wasn't. It's because like it grew into it. That's where like this stuff gets hard and the most speculative. And that's where people are willing to just ignore everything and bet on crazy stories and stuff. But sometimes, those stories are right.
Yeah.
So for people scoring at home, discounting a cash flow doesn't mean just this quarter, last quarter, 2 quarters. Sometimes you got to think about where might this thing be in 5-10 years. And that requires a bunch of hardcore like analysis on trends and social change and policy. And like that's where it actually gets hard. But that's where the real alpha lies, is figuring that stuff out.
Yeah.
And value for value's sake, if you could have bought Lululemon 50% ago and it was value play, right? So like just value doesn't always work. Value with a catalyst, value with momentum.
You know what? That's actually, hold on. So you just made a really good point that highlights the point I think both of us are making. We got into Lululemon. I think we made a little bit of money on it. Didn't we trim some profits?
I think we maybe had 2 different shots. One, I think was good. The second shot, it was like kind of instantly didn't work. And was like, all right, never mind.
Yeah. I think we walked a little profit on it. But we bought that for value reasons and we sold it because of the chart.
Yeah.
And that was the right thing to do.
Saved a whole lot of pain.
Yeah, saved a ton of pain.
Yeah.
Now, one that I didn't do that on, that I don't regret. I mean, I guess I do. Anytime a stock drops significantly and somebody goes, "Do you wish you could have sold it and bought it back lower?" Well, of course, right?
Right.
But it was Sprout Farmers Market, but we trimmed substantially at a much higher level. And however, having said that, now I still think the long-term thesis is very much in play, and I don't think it's changed at all. And I think the market way overreacted. But on that one, had I listened to the technicals more on that,
Right.
that would have saved me some pain too. So again, I found that stock via the fundamentals, and I would have been better. And we trimmed based on the technicals and the charts, so that saved us some pain. But the Lululemon one to me is the perfect example, right? You get in there for value, made a little money, got out for technicals, and thank God we did, because that thing's down 50% since we dumped it.
I think every value person I know is in that thing and has been in that thing the whole time. So
yeah, and you listen. There's other things.
And that may still work great moving forward, but
there's some serious headwinds there, and I've identified those through the research department of Samel and Avery, my wife and daughter.
Right.
They have got their finger on the pulse of retail, and they love everything that is Lululemon. But my wife is starting to buy other yoga pants,
right?
Because she's like, Zach, they're just as good, and they're a third the price.
Right. Most people are just happy to do Fabletics or something these days, like whatever.
Yep. Especially inflation, right? Easy way to overcome that. And their sales are really reflecting that,
especially in the U.S.
Yeah. And I think
that's the big market for them.
And I think they're going to be forced to cut prices and shrink margins.
And the hard part with that is you kind of cut some of the signaling of you being the big, a fancy brand if you cut prices enough.
Yeah.
It's like an interesting thing, like Walmart, and like you have some of these like brands that used to be really powerful and like this is like a good brand, and now it's like at Walmart because they like fell down the value chain of branding, and you're like, wow, that's in Walmart now. And you think about it like, no one likes that anymore. That's right.
Yeah. No, and it's brand murder, right? Yeah. That's one of the tough things that makes apparel and clothing sector so tough, right? Because those fads can change so fast, man. It's like neck breaking pace.
And there's like 3 athleisure brands that are like cooler with the cool kids now than Lululemon. Like, I can't remember what they're called, but all it takes is like 2 people in Hollywood to wear your crap, and now you're cooler than everybody else. And
then one of the new ones that's popping up too is that a lot of these influencers are teaming up with these small, fledgling brands too, and that's driving a lot of demand.
Yeah, that turns out that works.
Yeah, and but it also makes a mess of a sector, right? Yeah. Because where you had 3 main players, now you got like 13 to 20, and it just separates it. Margins get killed. Good for the small player, but that company went from being a stock that I was licking my chops at to sitting back and going, boy, that board just got really difficult.
Yeah, retail's hard.
It's
there's a reason I don't think I've ever. I take it back. Nike at one point we owned because of me, and then we got out. But I think it's the only one I've ever brought to the table since I worked here because I just don't like retail. I can't figure that stuff out.
No, it's too hard.
I can game out oil demand. I cannot game out teenage demand for clothes.
Oh, yeah. If you figure that out, let me know, would you? Let's see I actually have to run.
Yep.
I got a meeting.
Why don't you bring me your mouse?
Okay,
I think that'll work.
Okay, let me see the people they're getting the real stuff.
Yeah, you guys are gonna have to just deal with this.
Yeah. You know what? We don't do video anymore. We're not doing video.
Right. Who cares?
Week.
Yeah.
So you got audio. Never mind.
All right. There's gonna be dead space at the end where I go unplug here, guys.
Yes. All right. Have a good one. We'll see you guys next week.
All right. So S&P closed up 0.91, and that is above the 50-day moving average. The Q's up 0.62, also above the 50-day moving average, though less so. And actually, Q's are kind of testing the old uptrend line from the bottom. As I kind of have been saying, both internally and I think yesterday, I do think the bottom's probably in for the year. I think you're going to be fine from here. We will have pushed into positive gamma, which reduces volatility. Is going to reduce these like intraday big movements. So I honestly don't think you're going to have new big lows. That doesn't mean there's not going to be churn within the indexes, and it doesn't mean it's smooth sailing next year. But for the rest of the year, I think the Santa Claus rally probably actually will take over. Small caps up over 2%, a little bit there. You had equal weight up 1.4. So I think it's noteworthy. Equal weight, small caps, and all world XUS all beat the S&P today. All world XUS was up 1.22. The dollar down 0.38. So the dollar finally, this is maybe one of the bigger stories to me today. Dollar finally reacting to the rate cut, kind of getting thoroughly priced again. I mentioned yesterday it was kind of interesting that it hadn't fallen even with the rate cut odds. Well, now all of a sudden maybe making up for that. Bitcoin down 1.4, but still at 87,000. So you're still about 7% off the lows. Not super strong action, but again, still 7% off the lows. Oil down another 1.4. I think oil continues to sort of grapple with the fact that demand isn't good, supply isn't good, and the fact that you have these somewhat promising at this point peace talks with an ultimate potential, at least freeze in the conflict between Russia and Ukraine, which may well bring back some Russian oil, even though it's not really down that much anyway. I do think at some point you might get low enough on oil to make it interesting again. That might be the 40s before this is done. But gas actually pretty rough day today, despite the fact that, in my opinion, the weather models haven't really changed in a bad way. So I'm for the moment at least seeing that as an opportunity. Gold up 0.8, silver up 1.35, copper up another 1, and I think copper's looking pretty interesting. It faded a much bigger move on the day, but I'm kind of liking the way copper's shaping up personally. In yield land, you were down 4 basis points on the 2-year and 3 on the 10. And a lot of this was we got some consumer sentiment data come in, and it was bad. And it was bad, not just bad in general, but bad for kind of the labor market. And I think a lot of people are assuming we're at least going to get this one more cut, maybe, and then a freeze, just based on the labor market still looking at least shaky enough to do that. Within Mag 7, Oracle down again. So even though you have the market up 1%, you have Oracle down another 1.6, down more after hours. Apple up a little bit, Google up 1.5. Noteworthy fade from being up a good bit more than that at one point. I think you finally had people like us that probably, believed in this thing and were long, kind of selling to some of the newcomers, taking some profits, trimming a little bit after it's won significantly this year, which makes perfect sense. Microsoft up 0.6, Meta up 3.8, and it came out today that Meta is talking to Google about buying some of their chips, which is obviously a huge deal in many ways. And I assume Meta's up because, probably short-term oversold and needs to bounce. But if they can get these Google chips for cheaper than they can get Nvidia chips, since they're a massive AI capex spender, if they can save a couple percent on their cost of chips, that actually is a huge deal. It's a lot of money. Tesla up 0.39, basically flat when you take in after hours. Now Nvidia down 2.6 and down more after hours. We had a very healthy, robust debate in our internal kind of investment meeting today on Nvidia. We took a small short position in it today. I very well maybe stopped out in no time on that, but I do think you can argue that something has changed here with Nvidia, given the fact that if you really think about it, what all that matters in equities, in my opinion, is what's in the price and what's not. And I think what was in the price of Nvidia was them dominating chip sales and keeping really robust margins for years to come. So if all of a sudden they don't just have competition, but kind of legit competition, and I would argue these TPUs could be the first like real competition they've seen. That doesn't mean it's going to take 30% of their market share or something crazy. But it might take enough market share to at least force them to cut their prices to be more competitive. Which of course just means that their very, very robust margins might decrease. And that would be enough to really, in my opinion, re-rate the stock lower. So how this develops from here is going to be interesting. I do think Nvidia, the story has changed. They've had 2 news failures, as I think I talked about yesterday. In the last month, earnings and potentially selling chips to China, and the market was like, yeah, I don't care. Usually a big deal when a general, a market leader has really good news and it doesn't go up, especially after we had years of Nvidia going up on even mediocre news. So that's notable. Also on the day, you had Amazon up about 1.5. Vol down again. You're now down about 3%. You're down at 19.3 on front month vol. Not cheap yet, but it getting more reasonable after we were up around 22. I think that's it for the market wrap. The only thing other things I can think of, I'll spend a couple seconds on the Russia-Ukraine stuff. We talked a little bit about it Friday. My assumption was it probably wasn't going anywhere because it was essentially the U.S. negotiating with Russia instead of Russia negotiating with Ukraine and Europe. Now the U.S. sort of has an agreement with Russia, and now they sort of have a new agreement with Ukraine. So it's all about trying to get the two sides together to talk about the differences and the changes that had to be made to get Ukraine on board. I have no idea how that's going to go. It does seem like both sides are taking potential peace a little more seriously than in the past. So, I don't think it's crazy to have some optimism around that. Both sides clearly aren't going to win any great victories. Like, Russia's not going to take over the country. They've had 1 million casualties taking a couple provinces. They're not going to take the whole country. And Ukraine's not probably going to get much of their land back, even if they fought really hard and, lost a bunch of people and spent a bunch of money and took a bunch of pain of having their, grid hit repeatedly, et cetera. So the chances of either side getting any incremental win from here, especially cost adjusted, is just not great. So it makes sense for both sides to be reasonably motivated to try to do something here. Now, are the Ukrainians willing to dramatically reduce the size of their military or, give back more land than they want to or whatever? Yet no. And is Russia going to be cool with them having a giant military and still being able to get into NATO and stuff like that? No. So there are details that absolutely both sides are going to have to give on to make it work. But I think you can make the argument it looks more possible than it ever has. So that's worth following. I think there is a chance oil gets hit on that. I think it might end up getting hit too much on that if it actually comes to pass, which could end up being an opportunity. So that's something to think about and keep an eye on. I mentioned earlier as far as data went today, and I'll go into that a little bit. We had a retail sales. Now this is from September, so pretty stale, but it was worse than expected. Kind of notable. Probably one of the reasons a Fed cut is picking up. You had the Philly Fed's non-manufacturing activity bad again. In control group retail sales, which is kind of it gets rid of a bunch of the noise in retail sales. It's really volatile. In my opinion, the best way to follow it. People were expecting that to be a 0.3, and it came in at a negative 0.1. So not just retail sales disappointing, but actually disappointing a lot, I would say. PPI came in higher than expectations, so that sort of, I view it as a leading indicator of future inflation coming in pretty warm. So something to keep in mind. House prices about as expected. If you look at the Case-Shiller 20 city, your home prices are up 1.36% year over year. So call it flat, honestly. Home prices have now gone flat. And I think a lot of people in finance are viewing this as like a catastrophe and we got to find a way to juice housing market. To me, this is perfect. You need home prices to stay flat for 5 years while wages are picking up at 3% a year or something. So let people's purchasing power catch up to home prices. Most people are just thinking let's slash rates to juice housing. I think that actually makes most things worse. You had the Richmond Fed, which came through pretty bad. You were expecting -5 on that for the manufacturing index. You got -15 instead. So a lot of the soft data is coming in really bad. And then Conference Board's consumer confidence was expected at 93.3 and came in at 88.7. So that thing did not miss. That thing was atrocious. Their present situation index was really bad. Their expectations was really bad and way lower than it was last time. The one good news really data-wise is pending home sales were a little better than expected. But other than that, pretty poor data today. But data's been mixed for months. None of this data suggests recession imminent or some big problem. But it also doesn't suggest things are going great and you're about to reaccelerate and have a 2026 boom the way a lot of people are framing that. So that's where we are data-wise, market-wise. news wise, I think we've caught you up. So yeah, I think that's it for me today. And don't forget, you can download, subscribe at knowyourriskpodcast.com. You can follow Zach and I on social media. By this time, you know where. And then usually I would say you can check us out on YouTube, but this week, nope. So post holidays, check us out on YouTube. That's it for me. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.